Every now and then we stumble upon a little-known stock that's performing insanely well. And all we can do is ask, why? Even in a hideous market like this one, you still get those great undiscovered stories from time to time, although it happens a lot less often. But it does happen. This time I'm talking about Bowlero, not the musical piece, the bowling chain with more than 300 locations across North America. Now, you might recognize them as Cramer fave Bowlmore Lanes or AMF. Here's a stock that's delivered a huge quarter. It's up almost 44% year to date. This is a very unlikely winner. See, Bowlero is the product of a SPAC merger of all things. Regular viewers know that I normally hate anything connected to the SPAC wave. And the last few years have been just horrific. Mainly because most of them have been amazingly horrible money losers. Last week, we highlighted some data from D.A. Davidson where they found that less than 10% of these post-merger SPAC stocks were trading above the level where the SPAC came public. On average, they're down 51%. Bowlero's managed to buck that trend, though. Like every SPAC, it started trading at $10. Now it's at $12.98, giving you a nearly 30% gain. Somehow, in an awful market where SPACs are utterly despised, this thing's been able to march steadily higher. So what the heck does Bowlero have going for it to fuel this kind of move? And I'm going to give you a little heads up. You can look at this. See? I wore this especially for the show. By the way, it's a Ferragamo, just in case you're thinking that it might be from Mo Ginsberg. For starters, you need to know that even though it's a SPAC play, it's a throwback to the old days, back when these special purpose acquisition vehicles had a very different function. In the last few years, most SPAC deals are simply schemes that allow startups to come public without having to comply with the SEC's regulations for initial public offerings. It's a way to go around the government. That's how we ended up with hundreds of SPACs making venture capital-style bets on business plans, not real businesses. Now the market's turned against those stories, which is why most of the recent SPAC plays have been utterly obliterated. But if you go back a few years further, SPACs were very different. Although they were still blank check companies, so to speak, their purpose was to make lots of little acquisitions and roll up a particular industry. Some of them worked out very well for shareholders over the long haul. Bowlero's got going with that older model. This is a nice and simple bowling chain that's on a mission to consolidate the enormous yet highly fragmented bowling market. I mean, did you know that bowling is actually the #1 participatory sport in America? #1. Roughly 70 million people go bowling every year. But there are very few large chains. We've got 3,500 different independent bowling alley operators in the United States, representing an incredible consolidation opportunity for Bowlero, especially since the locations tend to make a lot more money than the industry average. I love that simplicity. They're using the SPAC for its intended purpose, raising capital that they spend on lots of little acquisitions to take over a niche industry. Initially, there wasn't a ton of excitement for this one, though. In July 1st of last year, we learned that a SPAC called Isos Acquisition Corp would be merging with Bowlero in a deal that valued the company at $2.6 billion. That transaction closed in mid-December after the SPAC boom had already started going bust. So Bowlero stock got crushed, falling below $7 by early February. In retrospect, that was a tremendous electric buying opportunity, as Bowlero's stock roared back to $13 as of today, steadily making a series of higher highs and higher lows over the past 8 months. We love that chart. What explains the strength? It's very straightforward. Bowlero keeps posting fantastic earnings numbers. On February 9th, they delivered a nice top and bottom line beat, with revenue up 11% from pre-pandemic levels and much better than expected profitability. In May, Bowlero reported another strong set of numbers, and this is their most important quarter of the year. Not only did the company have phenomenal revenue growth, up 130% year over year, and 26% from pre-pandemic levels, which is really terrific, their same-store sales were up 12% versus the same period before COVID. At the same time, they also gave you record earnings before interest, taxes, depreciation, and amortization, up 61% versus the same period in 2019. And that's really much higher than expected. I can't believe how great the quarter was. Best of all, 4 weeks ago, Bowlero reported another stunning top and bottom line beat. They generated $267 million in revenue. Wall Street was only looking for $195 million. Same-store sales were up 53% versus pre-pandemic levels. EBITDA came in at $82 million. The Street was only looking for $58 million, up 95% year-over-year and 141% versus 2019. Show me another company that's doing that well. They are gigantic numbers. Bowlero can put up this kind of growth in part because people keep coming back to the bowling alley. but also because they're making a bunch of little acquisitions to grow their footprint. In the 12 months ending this June, they bought 29 additional bowling centers. It's a good time to expand if you're in the bowling business. As President and CFO Brett Parker explained, quote, "We continue to see very strong demand in our bowling centers. Additionally, the new units are accelerating our growth rates as we open 4 new locations during the quarter," end quote. At the same time, their margins are exploding higher because a bowling alley has tremendous operating leverage as more people go back to the lanes. In short, Bowlero is a quality SPAC play that has almost nothing in common with its SPAC brethren. This was already a good existing business before it came public, and they've been putting the money they raised from the SPAC merger to work on buying up these bowling centers. Since the last quarter, they bought another one and signed definitive purchase agreements for 8 more. That's giving their numbers a big boost. It's exactly what a SPAC was meant for. Plus, unlike most SPAC plays that consistently overpromised and underdelivered, Bowlero is on pace to beat its own forecast. There's one more big difference. With most SPAC plays, it's tough to get a handle on how many shares are actually out there. New stock seems to come out of nowhere, diluting anyone who is foolish enough to be a buyer. But Bowlero's going the opposite way. Back on February 7th, when the stock was down in the dumps, they announced a 200 million share and warned buyback. Buy. Not a selling expedition, but a buyback. In the spring, they redeemed all outstanding warrants, getting the dilution under control. It's like a real company. Thanks to the buyback, they've already retired 80% of the new shares created during the redemption process, and they've still got 160 million left in firepower for more authorization. Now, get this. In short, Bowlero is the least SPAC-like of all the SPAC plays I've seen in recent years, and I've looked at every one of them. That's why it's starting to gain sponsorship. There are now 5 sell-side analysts covering this thing, all with buy ratings and an average price target of $17. I think it's still early enough in the stock's life cycle to be worth buying here. We could have been earlier, but I'm confident we're not late. Bottom line, when it comes to Bowlero, I actually believe the hype. This thing is a strike, not another SPAC gutter ball. You've got my blessing to buy it right here, especially since the stock's pulled back a couple of bucks from where it was trading after last month's amazing earnings report. Oh, by the way, when I bowled there last, I got a 117, but back when I had hair, I once bowled a 143.